Hey everyone, welcome back to the channel. Today we're diving into one of the biggest financial stories of 2024, the US bond market crash, and how it hammered investors in Taiwan, and you've probably heard it before. Bonds are safe. Well, this time, that belief got shattered at S, and we're going to break it all down in 4 parts. 1 at why US Treasuries crashed, 2 to how Taiwanese investors got hit, 3 case studies of real losses, 4 what you can do now to avoid the same fate. In 2025, U.S. Treasury bonds fell off a cliff. The 10-year yield surged past 5%, the highest since 2007.3. Key reasons caused this. 1. Persistent inflation. U.S. CPI stayed hot. The Fed delayed rate cuts, and investors realized high rates are here to stay. 2. Government debt explosion. The U.S. issued a massive amount of new bonds, flooding the market. Supply outpaced demand. Prices dropped, and yields spiked. 3. Lower demand for safe havens. With high returns from cash savings and stocks, bonds became unattractive. Investors pulled out. Bottom line, treasuries went from safe haven to sucker trap. Here's why many in Taiwan took heavy hits. 1. They thought bonds couldn't lose money. Many were sold stable income ETFs, not realizing bond prices can crash. 2. They chased monthly payouts. High-yield ETFs looked attractive, but those payouts often came for principal. Total losses outweighed the income. 3. Terrible timing. Many bought in late 2022 and 2023 when yields peaked, just before prices nosedive. Let us have case studies. Real people, real losses. Case 1. TLT Bond ETF Trap. One investor bought TLT at $110 in early 2023, expecting safe returns. By late 2024, it dropped to $85, a 22% loss. Total yield from interest? Less than 5%. Net loss? Nearly 20%. Case 2. Leveraged futures blowup. Another investor used 2x leverage on 10-year Treasury futures, betting on a Fed pivot. Yields kept rising. His margin ran out. Forced liquidation equals 6-figure loss. Takeaway: bonds aren't risk-free. You just might not know where the risk is hiding. Even hedge funds got burned. Many used cheap financing, like yen or euro loans, to buy U.S. Treasuries for carry trades. But in 2024, yields spiked. Prices dropped hard. Instead of earning interest, they lost capital. Fast. Worse, the basis trade also broke down. This strategy buys cash treasuries and shorts futures to exploit tiny price gaps. Problem? 1. It's highly leveraged, 10x to 50x. 2. When the spread widened, they needed to post huge margin. 3. Many were forced to dump treasuries. Crashing prices further. It was a feedback loop of panic selling. Taiwan's financial system didn't escape from this crisis. First, insurance firms took major hits from bond losses. Some sold off Taiwan stocks to protect capital ratios. Then investor confidence shook as bond ETFs tanked. People questioned asset allocation itself. Finally, financial stocks like Cathay and Fubon got dumped. Local bond ETFs like 00687B and 00720B saw massive redemptions. The damage was widespread and psychological. Now, we provide you 4 things smart investors should do now. 1. Rethink risk versus return. Bonds are not savings accounts. Prices move. Markets shift. Accept that. 2. Don't chase yield or use leverage. High monthly income often hides real danger. Leverage multiplies at. 3. Adjust your asset mix regularly. Allocation isn't set and forget. It needs updates as markets evolve. 4. Keep cash and short-term tools. Sometimes the best move is to sit out. High-yield savings and money markets can be smart shelters. This bond crash wasn't punishment. It was a $1 million masterclass. Lessons learned. Lesson 1. No such thing as guaranteed investments. Lesson 2. High yield often equal high risk. Lesson 3. Asset allocation must be dynamic. Lesson 4. Stay humble. Markets don't care what you expect. Investing isn't gambling. It's discipline. If you found this helpful, hit that like button, subscribe, and leave a comment. See you next time.